A very warm welcome to all the investors present here today. We have with us our founder, Dr. Mohit Batra, and CIO Mojo PMS, Mr. Sunil Damania, live in today's Q&A session. Bring any of your concerns, challenges, and curiosities on the stock market, and we'll be happy to answer them. Over to you, Mr. Sunil.
Thanks a lot, Jason, and a very warm welcome, all of you. The market has been playing, I think, when we look at this 2025 in a flashback, it turned out to be extremely challenging year. Not only for the professional fund manager, but also for the Indian retail investors. Post-COVID, this is the first year that retail investors took money out of the Indian equity market. Okay, and when I'm saying taking money out of the Indian equity market, what I mean to say is direct, which has been, of course, the money that has come through mutual funds is different. As per the NSE, the data says that 1,090 crore, that's a negative, has taken out by the retail investors in 2025. That shows the amount of frustration the retail investors face. That normal belief that retail investors will put money when FIs are putting money. But when you look at the data and you compare FI money month to month and retail investors money month to month, there's a complete contrast. And let me tell you how. The first quarter of calendar year 2025, FPI basically had a heavy selling in Indian equity market because of tariff, because of HPMF virus, and so on and so forth. On the other hand, the retail investors pumped in money in the Indian equity market. The second quarter completely reversed. Retail investors took money out of the Indian equity market. FPI put money, and the third quarter again there is a reverse. While the retail investors put money, the FPI basically took the money out. But in a year, when I look at YTD, both FPI took money out of the Indian equity market, and so is the case of retail investors taking money out of the Indian equity market. But of course, retail investors also pumped in money through the mutual fund, but I'm only talking about direct investment be taking place. Month of December turning out to be one of the lowest volume of 2025. I most probably we would close near about 90,000 crore or so. And when you look at the volume in 2025, very few months we crossed 1 lakh crore. That also shows what kind of sentiment Indian equity market had. Now there is a very funny thing which is happening in the market, and sometimes we make an assumption कि ये होगा तो ये होना ही चाहिए. But ऐसा होता नहीं है. And I'll tell you a live example of that. Let's look at the US market, which is one of the best performing in equity in 2025. What happened with US? The first time in the history, the US credit rating got all three agencies basically downgraded, taken away AAA credit, and the last one was Moody in 2025. First time in the history, the longest close down of the government, 43 days. And then inflation kept on rising extremely, the elevated level, and yet US market gave bountiful returns. On the other hand, Indian equity market, year started with budget which gave a handsome boost to on the personal tax benefit. Inflation remained very, very benign. 125 bips rate cut happening from the RBI. Normally when the rate cuts happen, the equity market should do well. Am I right? GST reforms happen. Corporate earnings came out extremely well for September, and yet Indian equity market struggled to even perform. And when I look at the market cap of India in a dollar terms in 2025, despite near about 1.6 lakh crore IPO coming in, despite 7 lakhs DII money coming in as an investment, net investment, the market cap of India is the same as what it was in December 2024 in dollar terms. Why am I saying so in dollar terms? Because Indian economy did move up by 5%, but at the same time we saw 5% decline in rupee value versus the dollar. So that gives an idea that sometimes look assumption, and of course crude oil. Everything was going wrong for the crude oil. We saw Ukraine and Russia at different level of escalation. We saw a Red Sea issue. Iran got attacked, and 3 nuclear facilities. US basically made an attack on that. So whenever we have seen in the past when there is a geopolitical tension, the crude oil price would spur. This time, India's crude oil basket was $80 per barrel. As of yesterday, it was $60 per barrel. So on $20 per barrel kind of a decline we have seen despite heightened geopolitical situation which happened in 2025. So my request to all of you, stop making that linear assumption now कि ये होगा तो ये होना ही चाहिए. I think the market has become more complex and more interlinked, in fact, and hence you need a lot of expertise to understand the market. With this opening remarks, I'll hand it over to Mohit for his remarks, please.
Thanks a lot, Sunil. A very good evening to all of you. We've had a series of webinars, I think, last couple of weeks, where both Sunil and me have repeatedly come in front of you. We have explained to you what our view is and why is that view. We've also thrown light on the fundamental factors that are strengthening up very quietly for the Indian economy, which will sooner or later yield us out of the current situation. Obviously, there are fundamental factors, there are government factors, there are tariff price settling in that we've spoken about. We've also spoken about a large gap in the price to earning averages that we've seen over the last 10 years versus predominantly mid and small. And we've also spoken about what the top 100 companies of MarketsMojo indicate in terms of the market cap allocations and where we feel the revival can start happening. Now, having said that, we've also seen a very selective revival happening across some of the mid caps and some of the small cap stocks that we've shown you in our presentation. It's a matter of time that the market gets out of this particular mode, and I think being in the market is the most paramount thing for all of us, despite so much pain that we have taken as investors over the last 1 to 2 years almost now. There is a tipping point that comes where your patience is tested at the most, but at that time itself, it's just about one more step or one more day. You have to keep tagging along to make sure that you stay in the market rather than stay out of the market, as a lot of other investors are doing predominantly in the last 1 year, as Sunil pointed out. We will today have a power series, which means that for some of our new investors, power series is a format where we keep quiet and we let you ask questions. And Sunil and me will together try and answer as many questions as possible on the platform. So we will move on to that. Before I move on, I must tell you that some of our long-term investors who have been 10-year plus and 15-year plus investors have repeatedly asked us if we had done an offer. They are repeatedly asking us if we can only do a US access to them because they already have India for a long period of time, which is 10-15 years. So if I can go to the slide and show you that we have, for a very limited time, we are offering our 5-year, 10-year plus members a US link only. And this is a very, very exciting link. This is the MRP of 1 year of the US plan itself on site is 29,999. What we have decided that we will take 19,999 instead of 29,000, and along with that we will give 4 years free. So it will become a 5-year pack, which is 19,999. So just about extending it 2 times, you can have a 10-year uninterrupted pack of the US market only. As I said, this is more applicable to long-term investors who are with us for 10, 15, 20 years, some of the Mojo professional investors. We've heard your request, and this is a special link that today we are giving in the webinar. This link is that this link is not available on the site. So this is only for our Mojo professional users who are on this particular webinar. Please make sure that you take this up. We will be closing this. This is a very, very special offer because we're giving 4 years free here. We will be closing this offer very soon, maybe in the next few hours itself. All the other links are also about to expire. What you are doing on the India access is Mojo 1 is today on the website priced at 19,999, and stock of the week is priced at an extra 14,999, which takes the package to 34,999. We are giving that out for 14,999, but that is not it. We are giving 2 years extra free. So this is a 3-year plan that we are giving, which is for 14,999 for investors who only want to look at India and everything that is in India. This is a combo plan of Mojo One plus stock of the week available for 14,999, which has 3-year access, not 1 year, but 3-year access. And you can extend this multiple times to have a long-term membership with MarketsMojo. As I said, this link has been going on for a week almost now. We will be expiring this link as well. And the last is my favorite one, which is India plus US. If you look at India plus US, again, the total package cost is 64,000. We are giving it for 19,999. This has 3 years of India plus US package, everything included. So this is for investors who like to know that India is not alone, but we are coupled with the largest economy in the world, and it also is paramount to make sure that we track this largest economy. There are a lot of brokers who are today offering services to buy US stocks. So this package becomes very, very important to make sure that you have a view not just on India, but also on US. This is for 19,999, which has 2 years of free access. So this is a 3-year package that we have. These two links will expire very soon. I would request you to only access these links on the webinar. Below the video that you see or above the video, you see the links. That is the only place you can access this. Once the webinar is over, these links will go away. So please make sure that you are accessing these links to ensure that you have a huge discounted long-term association with MarketsMojo. With that note, let's straight get on to Q&A.
Okay, starting this first question by Seema Pawar. I want to understand why none of the stock recommendations have a stop loss.
None of the stock recommendations have a stop loss because we don't believe in a stop loss. The reason the stop loss works is stop loss is a parameter which is basis various risk profiles. A conservative investor may have a 5%, 10% stop loss. The other investor may have a 15%. Some aggressive investors may have a 20-25% of stop loss also built in. We are fundamental players, which basically means that we will keep our rating on a particular stock despite it is currently in the current scenario working or not working. Our belief has been that fundamental stocks sooner or later will get the price appreciation, and that has always happened. Have we tried a stop loss in the past? The answer is yes, we have, and we have terribly failed, primarily because we've seen fundamentally strong stocks can even come down 20-25%, but their rebound can happen much faster again. So considering all of this, which is stop loss A being a investor specific criteria, B, it is not something that works well on fundamental investing where you are fundamentally betting on a stock despite the current price up and down. And C, we've seen huge amount of turnarounds of stocks who broken 10-15% as well, but they have then bounced back very smartly. Wherever we've seen that we put stop loss in some of the strategies, we do put stop loss. We've seen that mostly we've failed because fundamentally strong stocks will come back. It's a question of being patient and making sure that you're following. And if the stock is at a strong buy or a buy approach, then I think stop loss is not the right thing to look at. It can be a portfolio level parameter, but that is something that you can decide at a portfolio level what kind of drawdown you want to take, what kind of risk you want to take. But on a fundamental investing, there is no stop loss ever in the equity markets. Any research house that you go will have a target price predominantly, but they will not have a stop loss. Right? Because if the stock is fundamentally good, because research is fundamental, if the stock is fundamentally good, goes down, then the expectation is the stock should come up. Stop loss is a portfolio specific parameter.
Okay, I'll move to this next question by Arun Ramchandran. Hi both, since you started Markets Mojo, what is your assessment of the evolution of retail investors' behavior? I guess there is still a lot of scope for improvement, but has it got any better? And any suggestions for investors in the same way financial professionals' behavior has also evolved with the democratization of information? I would like to appreciate the Markets Mojo team for being transparent and addressing all queries, even when they might be critical. I'm someone who's often have a critical opinion on Markets Mojo, but a lot of faith too.
Thanks a lot, Arun. I think primarily, if I see our journey with our investors over the last 10 years, and maybe Sunil can also add on to this, I personally do believe that there has been a sea change of investor psyche. People have, over a period of time, started listening to us. Now, and I'm saying this primarily because of my experience with investors on webinars or when I meet them, they trust us. So the first thing that happens is that, as you said, Arun, that people trust us. It's not a question of in 1 year if your performance is not there, or in 2 years your performance is not there, but then sometimes the performance will come. But I think one specific thing that we've seen in the mind of the investors is that they know that we are on the side of the investors. So we will always keep educating them, keep telling them how to do the right things, being in difficult markets. So more, I have personally seen a very sharp improvement in the listening capabilities, in the behavioral change of investors that I have been dealing with personally. Now, having said that, is that a very generic phenomena? The answer is no, because there are certain factors which we cannot change, despite us being always in front of the customers. Now, these parameters can be the risk appetite. The customer, the investor maybe did not access, because a lot of time what we've seen is a lot of people in Markets Mojo platform come with a lot of greed. We've delivered a lot on that particular greed over the last 10 years. But that greed is something that has to come with a lot of patience. You can be greedy, but you have to be then patient. You cannot be greedy and being impatient. Ke har saal mein mera to, I should be getting something every year, right? So what we've seen is a lot of investors who come on the site are extremely, they claim to be very aggressive. But when it comes, when the tire hits the road, and when we see that the markets have a drawdown, they really come forward as not those very aggressive customers. So I think, I keep telling people, because they keep asking us that, yeah, for example, when we did Infinity, people said, tell us the back tested returns. I said, no, we can't tell you because of, whatever SEBI regulations. But why would you want to know? Is because the highest of the return, which the portfolio has the highest return, is where I would invest. And that's not how it should be. Your allocation strategy should be irrespective of what returns or the backtesting returns that the portfolio may have. Your allocation strategy should be on your risk profile. So what we have noticed and our personal learning is that we can come a distance, but the investors also have to come a distance. Some investors do. Some investors travel a lesser distance, and some investors maybe go in the opposite direction after listening to us. So it's a mix, but overall, I think if you ask me, I think I've seen a very big difference in the investor psyche and the behavior. Sunil, you have anything to contribute there?
I think because I interact more often with the investors, and what I realize is that there's a huge improvement in last 1 decade in terms of a lot of information, a lot of awareness, a lot of education that happened with the investors. But one thing which still investors are missing in their mind or somewhere not able to overcome is their emotions. And I think the guy who makes money in the equity market is the guy who has a control over emotions. And this is, I've seen, and the 2025 has been really a very good year to taste the temperament of the investors. And as I was saying in my opening remark, the investor actually took money out of about 1090 crore retail investors in the equity market. So somewhere I think we still need to go a long way in terms of able to create that kind of a mindset that yes, equity market can be volatile. We should learn to accept that there will not be any gain without the pain. And I think those who join post-COVID, I think they believe that there is always a gain and there is no pain, which doesn't happen in any field. And so is the case with the equity market. So somewhere we need to start learning controlling our emotions. Many times, yesterday one of our Infinity customers wrote to us that how do we calculate the gain? Now I think, and that's a big surprise to me. And actually, I had to explain him that it's a simple formula where you put your present investment value divided by the investment you made, and then the counter questions comes from the investors through email that why are you computing unrealized gain as a part of your gain, and that surprises me because that's the so normal norms. So that gives you some the great. So I think we have started a journey in terms of education. People have taken a lot of efforts to educate themselves, but there is a long mile. In fact, when I also interact with some of PMS customers, they say, "अरे, इतना तो पैसा savings में बन जाता है, FD में बन जाता है," and that's where we need to learn that equity is all about non-linear returns, and that's where. And once we sink in, and someone asked a question to Mohit about the stop loss, I think again that mind of stop loss comes when you don't know what you are doing. If you know what you are doing, then there is no fear of stop loss, because if you know what the company is all about, the script can go down by 50% also and can make a strong bounce back to create wealth for you. But that 50%, that comfort level only can come when you know why you got into that company, and that's where we need to all understand. And then another thing which I seriously believe, somewhere we need to change that philosophy that everyone loves tips. If I give you 10 stocks to buy today, the number of people attending this webinar would be 10x. Okay, but the beauty in the life is that you need to take a portfolio approach, and I think we need to do a lot of still we have actually failed, in to be honest with you, to explain you that you need to don't have to have a stock specific approach, but portfolio approach. And when you take the portfolio approach, I think the whole life changes, and the investors who have not made money in the market will start making money because we are taking a portfolio approach. Because portfolio approach is more systematic approach where you look at the assets allocation in terms of market cap, in terms of sector exposure, single stock exposure, and so on and so forth, and that's how it happens. So yes, it's a journey which has started in a positive note. The curve is moving up, but we need to cover a miles before we can say that we have arrived in terms of our financial literacy.
Okay, I'll pick this next question by Athiraj. Hi Mohit, you previously spoke about the US market and also decoupling. Could you highlight more on that? Are there opportunities in the US market?
There are opportunities across all markets. I think the big, I was actually with a very, very senior private banker. I was having lunch with him today. He deals with a very large set of global clients. And I said, क्या चल रहा है भाई? What's going on? So he's saying, यार सबको US चाहिए. So I told him that, yeah, but you have seen the valuations. You've seen predominantly, it's basically nothing is right in that economy apart from the higher AI valuations that is holding the market. And he said that, yeah, that's absolutely right. But people don't chase current losers. People only chase, current winners. And we were having a very healthy discussion around it. So I personally feel that there are, if you were to look at, and at a certain point in time, if the global investing becomes more and more allowed in India, and I think government is taking, their due steps through Gift City, through various other parameters that we've seen. Then there are opportunities that typically are not there in India. For example, AI opportunities are not there in India. Large EV opportunities that are the way that the consumption can go in the US markets are not there in India because of the sheer infrastructure that they have. There are sectoral specific opportunities that may not be there in India, right? So there are opportunities that will be there in US for a long, long time. And there is the reason I'm saying that I was not talking about decoupling, and I was saying that the markets are still coupled, right? So if there is a big fall in the AI valuations that happen in US, India with no AI piece involved in will also initially feel the jitters, right? So, but the big move that can happen there is that the FPIs can return back to conventional weightages or heightening conventional weightages into conventional sectors and countries where the fundamental economic growth is still strong versus and at a reasonable valuation. So, looking at all of that, I think like global investors are global investors, I personally feel that Indians should also and will in the next 5 to 10 years have no choice but to become global investors because these innovations that drive the US market are something that we've not been able to do it at that pace, right? We've been more a follow-up economy. We have huge strength in service in value-added services in low-cost services in delivery platforms, in quality of work that we do, whether on servicing side and whether on manufacturing side. But we are still behind on the whole innovation piece, which typically the Western countries drive. And today, innovation gets rewarded a lot, essentially gets rewarded in a very fast way as well. Typically, it catches up. So I think we should always be ready as investors that if we see opportunities out there, and not just look at one market, but look at least the biggest market and try and understand what's happening out there.
Okay. Talking about US markets, Vineet has a question. Is this the lowest rate for USA? Because Christmas is coming and you may give additional discount. If I subscribe today, I'll lose out on the Christmas offer. So can you assure if this is the best rate for the USA plan?
Well, this is the best rate, and this rate will also go away. I must tell you, Vineet, if you can see the screen, we are charging for our 1 year rate is 29,999. We are charging 19,999. And we're giving 4 years free. I don't know whether Christmas or New Year's. The only other thing is I can give a free 10-year subscription. This is we've never done. Have you ever heard us give a 4-year pack free before? We've never done that, and we will never do that again. So I don't think so. 4 year will become further on the Christmas. You have my word for it that Christmas is not going to make this offer better. In fact, by Christmas, this offer may not be there. That is more probable than, especially the US excess, because other two offers are fine. This particular offer we have floated only primarily because a lot of our long-term investors have been messaging me, writing to me that why don't you give us a 10-year excess or a 15-year excess equivalent to our current excess on the US pack, and hence we made a 5-year pack for 19,999, which is with a 4-year free. So no, this offer will not become any better, whether Christmas or New Year's. In fact, this offer is valid only for some hours. So if you want this, please go ahead and take it.
Okay. Next question by Vatsalya. India Inc. grew merely by 5% in September quarter, while the GDP grew by 8.2%. Do you not see something wrong in the data fetching? Even IMF has rated us C for our financial statistics. What are your observations on this?
I think I don't know whether you got this, where this data came from 5%. If my memory serves me right, I think India Inc. grew by almost 14-15% in terms of bottom line. Maybe in terms of top line, you may be right that we must have grown at 5%. But GDP also as a component which are not part of what we call the listed space. So that would always be the case. So we will never see a apple to apple comparison of GDP is equivalent to India Inc. Top line growth. And historically, you look at it, and irrespective of which government is in power, this has always happened. In terms of your data, your point is that see for financial statistics, I think to some extent I agree with that because there is a lot of scope for improvement. But let me tell you very honestly, when you go through some of the data also of the developed market and especially US and maybe the China, I think there is a lot of scope for improvement there also. So yes, it's a work in progress. I think we need to see the problem happens in India that there are too many agencies which is compiling data, and then there is a every department has its own vested interest to take the data. So there is a problem. But are we saying that this 8.2 GDP is a little something off, or it's like it's 6%, but we are showing 8.2% kind of growth? I would not like to agree with that for the very simple reason because, and see, there are always supplement data which you can always match with. For example, look at the GST collection, which is you and me basically have paid that money by either while buying a car or consuming in a restaurant or staying in a hotel or so on and so forth. That GST is being calculated, is collected and paid to the government of India. And as long as the number of GST more or less in line with the what nominal GDP, I think I would take the data at the face value. So I'm not too much concerned about whether it's a C for finance statistics or not. I think if we say GDP is 8.2%, the probability is very high that GDP actually is at 8.2%.
I'll move to this next particular question. This is by Ajit Matthew. Hi Mohit, which Mojo scheme performed well this year? Model portfolio, Mojo stocks, hidden turnaround, momentum, or reliable, or stock of the weeks, or let's say the PMS or Infinity portfolios?
As far as my memory goes, and Ajiti, I will confirm back to you on this, but as far as my memory goes, reliable performers was the best this year's. And buy rated stocks were better than strong buy rated stocks. So these two things that we've seen, reliable performers performed extremely well this year. Mojo stocks obviously is a consistent, factor out there. But number one would be reliable, then would be Mojo, then would be actually momentum now this year, and then Mojo stocks. Model portfolios have done okay. I would not say that they have done very handsomely out there, but they have done fairly well. I think the star of this year has been the Infinity portfolios, for example, and take this data with a little bit of a lag. And I would like to put a disclaimer that I may be wrong on some numbers out here, but I'm giving you broad numbers out here. The top tier equity fund has been our top performing model portfolio across, with I think 11 to 12% return versus index of 2-3%. And very, very short duration. It's just been a 5-6 month product. Ultra aggressive on the other side has also done very well in Infinity. So these two portfolios and the small cap portfolio done exceptionally well despite what's happening in small cap. The small cap portfolio on a negative index is up by around 10-11%. So these have been the highlights. So if I were to summarize in terms of portfolios, top portfolios have been top tier equity, small cap, and ultra aggressive. In terms of strategies, it has been reliable, momentum now, and then Mojo stocks.
Okay, I'll move to this next question by Mohammed Tahir. I do appreciate your efforts. I request to include the gold, silver, cash in percentage in some of the portfolios.
Sorry, Jason, I missed that question completely.
Yeah, I think Mr. Sunil had also showed something about gold, silver, cash in percentage for the portfolios. So Mohammed Tahir had said that I do appreciate your efforts. I also request you to include and talk about the slides of gold, silver, cash in percentage in some of the portfolios.
You're saying that we should include these asset classes in some of the portfolios. Is that what you're
Yes,
saying?
yes.
Okay, so see, these are very specific mandated portfolios. They, may look good because of the way commodities have moved in the recent past. What we are definitely planning to do under Infinity is launch a multi-commodity or a multi-asset scheme, which will invest in, in equities, in debt, in commodities, which includes gold and silver in a proportionate way through the ETF route. So that is one portfolio that I think in the next 1 month we'll launch under Infinity. So, you can, for example, we can take Nifties out there, we can take mid-cap indices out there, we can take, gold ETF out there. So we'll be able to take asset allocation approach towards asset classes and run it not with an underlying stock or a mutual fund, but through ETFs. So we have been planning to launch this. I think in a month's time we should be able to launch that out.
Okay. I'll move on to this next question. This is by Rinku. Hello, Sunil sir. First of all, thank you so much. With your guidance, I've been able to generate excellent return in my gold and silver investment. I'm grateful to MarketsMojo. I have a question regarding IPO section. What exactly should we understand from the IPO ratings given on MarketsMojo, such as subscribe or avoid? Does a subscribe rating imply applying mainly for listing gains and selling on the listing day if shares are allotted, or is it also meant for long-term investment?
Rinku sir, thanks for appreciating what we have been doing. I think our IPO ratings are very, very clearly not a momentum or a short-term buy. When we stated that IPO subscribe, that means it has to be subscribed for a long term, not for the listing gains. One classical example, and that we have been criticized too much about the Ola. If you remember, well, the whole world was saying subscribe, we said avoid on our IPO section, and then rest is history. So when we analyze the company, we analyze the company keeping in mind the business prospects of that company, quality of the management, the quality of the books, that is the financials, and based on that we recommend subscribe. So it's not for the listing gains, definitely not. So if it is avoid for long term, subscribe for long term.
Continuing with IPOs, this next question by Pawan Mandala. Good evening, team. Could you please clarify why some of the IPO recommendations are not good? For example, the Leela Hotels is still below the issue price. Also, Misho was given avoid, but it did double in 1 week of listing.
So I would not be able to comment on company specific because I'm bound by my compliance team not to give. But I would request you to look at Miso. I think Nitin Kamath talked about how short sellers got trapped into that and the price. If you go back to our analysis why Miso was avoided, purely because of the cash transaction that have been taken and the valuation and so on and so forth, it's all available on our site, so maybe you can go through that. And some companies are below price. I would not be able to comment because I would prefer to avoid company specific. But there's some data which has come out from the ministry where the number of tourists coming into this country has been lower than what it has been, and the I'm just giving as a sector view, not on Leela as in specific. So we have issues, with the aviation sector. We have issues with the hotel rates are being charged today. If I have to travel from Bombay to Dubai, I think I will be paying little less than what I'll be paying from Bombay to Lucknow. Okay, if I have to compare the hotel, if I have to stay in a Taj Lucknow, I would end up paying 35,000. If I go to Dubai and stay in a 5-star hotel, I'll be paying much less that. So I think somewhere we need to understand that there is nothing called infinite the buying power that the investors, the customer will pay. So somewhere the industry need to recognize that. Of course, we have been scheming the customers basically very badly. It's not going to last for long, and one of the reasons why number of tourists coming to India is a little less purely because of our the airline tickets and the hotels have become too expensive as compared to some of the competing assets. Even someone basically did a very beautiful analysis about in 2025 which city in Asia basically seen the largest inflow of the tourists, and Vietnam was the top of the table and India was at the bottom of the table. So that gives you an idea about if you go to Vietnam, the cost of staying or cost of eating out is quite reasonable as compared to what it is there. So that's the one reason why hotel as a sector, it looks to me, I think they need to reinvent themselves. Number one. Number two, if you look at every commentary of each and every hotel company, they want to expand. So number of rooms that are going to increase in the coming years is going to be substantially higher as compared to what it is. And that also explains, I think, market is becoming a little nervous about that, and that could be one reason why some of the hotel stocks are facing some amount of a headwinds. In fact, I gave one example very recently. I had gone to Vaishno Devi and I was staying in Taj property. Out of total, only 3 rooms were occupied. and normally you have a buffet morning breakfast basically, and they said, sir, we will not be able to do it. We'll serve you on the table because it doesn't make sense to have this one. And so that gives an idea, and purely that to some extent that because also of the Indigo episode that happened, that could be one reason why number of people staying in that hotel were very, very less.
Okay, continue this question by Vatsalya. Presently, most of the promoters are also offloading their stakes in IPOs at much higher rates and fooling investors. Do you agree? If yes, how do we analyze such IPOs?
So I think no one is fooling anyone. I think the promoters are making a disclaimer saying that I'm selling at so and so price. If you like it, please buy it. See, fooling is a statement, I think, where you hide something and you say something. I don't think they are fooling any investor. It's your comfort level whether you want to buy. I can understand if they cook the books and then asking you to pay that. That I don't think they are doing that actually. So promoters are making upfront कि बॉस मैं बेच रहा हूँ, आपको चाहिए तो ले लो, इस प्राइस में बेच रहा हूँ. It's a give and take situation, and the demand and supply will decide the price. How to analyze IPO? I think it's very simple, and the methodology that MarketsMojo follows is that the quality of the management, the quality of the book, and the business prospects. These are the three parameters we look at it to analyze the company. I would recommend you to do the same thing. But बोलते हैं ना, जब आपको अपने आप आम मिले तो पेड़ लगाने की क्या जरूरत है. जस्ट गो टू अवर IPO सेक्शन एंड यूज सब्सक्राइब एंड अवॉइड. व्हाई डू यू वांट टू एनालाइज ऑन योर ओन? Because you may not have a wherewithal even to analyze those companies, don't know how to look at the quality of the company, quality of the management. You may not have that wherewithal. So my simple advice would be, yes, do analysis, but I think the simplest way to just follow MarketsMojo IPO analysis section.
We've been discussing this question by a couple of lot of investors over here, so I would like to pick this up. It's by Rajiv. Sorry for sounding naive here. I already have a package for 3 years, so this 3 years would be added from the expiry of that period. How do I know my current package and eligibility?
If you take, let me take an example. I think I've been taking this example in every webinar. If you look at my slide, this is the India package, right? So you have 1 year of Mojo One today on the site at 19,999. 1 year of stock of the week is 14,999. So total price of Mojo One, which is the combo, is 34,999. What we are giving is 14,999 out here with 2 years free, right? So you are basically getting 3 years in 14,999. Now, when our investors are 10, 15, 20 years investors on Mojo One, the way they do it is that they don't look at their expiry. When they get a good offer, they will add 2, 3 times. So it adds on to their expiry date of the package. So if your package is expiring in, say, 2027 or 2028, whatever the case may be, if you take this package once, that expiry will become 2030 or 2031, as the case may be. If it is 2027, it will become 2030. You take it 2 times, it becomes 2033. So one of the unique features that we give our investors out here is even before their package is about to expire, even 1 year, 2 year, 3 year before, they can extend if they get a good offer. So they can extend and they can add on these 3 years to their expiry year. On the site, under the profile section, you will see what is your package expiry date. You can see it out there, and you can then decide whether you want to extend it once or twice. If you extend it once for 14,999, you add 3 years. If you extend twice, you obviously add 6 years. One of the main things that you need to note is that this offer is not available on the site. I'm repeating, this offer is not available on the site. It is only applicable through the link that you're seeing near the video. And if this link expires, then this offer expires. So please make sure if you have to extend it once or twice or 3 times, you typically use this particular link. Don't look for this offer on the site. It is only for webinar Mojo professional users. And we are going to maybe finish these links very soon. So please make sure that you use this link today itself to extend your packages multiple times and enjoy the services for a long period of time. Thank you.
cap funds. Could you suggest the best approach?
Well, it's very tough to give this answer here without doing a full profiling. But if you're saying that you're a moderate investor, I would typically say that if you have maybe 10 lakhs to invest, you should typically go in with an SIP approach right now. So that's one. I would not advise you to put everything in one go. I would typically say that maybe you can do a 6 month allocation. You can even do a 4 month allocation. So you can say, let's to make it easier. Let's say you do a 5 month allocation by investing 2 lakh each every month. So that will give you a little bit of a averaging when the markets are choppy. So that's one. But in terms of your allocation on large, mid, and small, if you are a moderate investor, I would typically suggest a large cap allocation of around 50% at least, mid-cap allocation of around, say, 30% and not more than 20% on small cap. Now, these are very, very broad level of allocation, may or may not apply to all investors. But I'm telling you, typically a moderate investor would typically see the market, see the allocations as maybe a large cap to a 50%, mid cap to a 30%, and 20% to a small cap.
Okay, this next question by Sandeep. Hi, what would be the impact if any of the recent interest rate increase in Japan would have on the Indian stock market?
No, repeat the question, Jason, please.
Yeah, what is the impact if any of the recent interest rate increase in Japan would have on the Indian stock market?
So, we did an analysis on that actually. We presented, I don't know, we presented with PMS customers or with the general public. So, total exposure of yen carry trade in India is near about 5 to 6 billion US dollar. Am I right? And within that, there was a lot of exposure within the mid and small cap. So that's what has happened. Now, 5 to 6 billion US dollar is near about a week up 54,000, 50,000 crore kind of a market cap that we are talking about. So we don't, I think, isn't an impact on India at all. In fact, what would happen if there is a trade carry for yen carry trade gets unwinding happens? I think a lot of money would move from US market, and in that case, eventually Indian equity market will come on the discussion table for the investors, for global investors to come. But if you look at globally, I think the yen carry trade, the value that has been sitting on the swan is not so huge as used to be in the past. So I don't think it's going to make a huge impact. And to some extent, it's a given thing that is going to increase. I don't know whether I did discuss with you people. We predicted three things in the month of December, for the month of December. One, RBI doing a rate cut. Second, Fed doing a rate cut. And third, Bank of Japan increasing the rate hike. If we could predict, I think the whole world is basically built into that. So I don't think it's going to come as a major surprise for the market to do that. But mota, we don't have too much exposure of yen carry. 5 to 6 billion US dollar mainly into mid and small cap. Hardly any impact on the Indian equity market.
Okay, this next question by Santosh Gaikwad. Thanks more than Sunil for your insights on the market and the overall overview. Is there any plan of launching a MarketsMojo mutual fund?
Well, the plan is there. I think it's a matter of time. We are giving it a serious thought, and our approach, I think we know our approach that we are going to take. It will be a very differentiated approach than what is there in the mutual fund industry today. The plan is there. I would say that wait for a year or two, at least, for us to, apply and then get the license and then and launch the whole service. So I would say maybe 2 to 3 years is a horizon where we can look at, because typically SEBI approval itself takes around a year. We haven't even applied, and not that we are going to apply recently, but it will take a little time for us to go there. But definitely, if it's on the card, answer is yes.
Okay, I'll pick this next question by Rajkumar. I see various stocks which are marked as excellent quality, and at the same time, there are many red flags also. Should we follow the quality criteria or plainly look at the Mojo score?
I think you should always follow the score because score considers the red flags as well as the quality. As you know, we have four parameters, which is quality, evaluation, current financial trend, and technicals. Normally, quality is a long-term parameter where the company over may have shown exceptional fundamental strength over the last 5 years, and that is the reason the quality is excellent. But sometimes in a quarter and 2 quarters, the company may not do that well, and hence the red flags can come in their quarterly results. They may have a decline in top line, they may have a decline in profit. The combination of all of this is the score. So instead of looking at these four parameters separately, I think what you need to do is look at the overall score. That is a better indicator. And then you can maybe deep dive. Quality can be more of a checklist for you to say that the quality is excellent and good. So that should give you added comfort. But in a score, all of these factors are already discounted in. So please follow the score.
Okay, I'll move on to this next question by Kawaljeet. Can we get an option to filter out the highest score across the market? Also, can we get a model portfolio with only small cap or only mid cap or only large cap?
So the answer to the first question has been no for the last 10 years and still say no. But the reason, Kamaljeet, is because there are a lot of broking partners who take up package of ours, and then this information can be disseminated very easily. That is the reason right from the beginning we haven't given a scoring filtration on scores. So we'll not be able to do that. And that's also one of the reasons that we don't give a download option of scores as well. So we'll not be able to do that. We already have a profile specific, a small cap portfolio that we've done in Infinity. If you want to access that, you can access that one portfolio. But obviously, if we feel that there is enough demand for us to launch model portfolios, which are small, mid, or large cap, we can definitely look at that. Why not?
But any reason why we are not getting any stock from metal or oil refining sector in reliable category to this those sector doing well? So I don't know whether, but I think very recently Mohit released one stock of the month, which is from the metal, and we do have some of the oil refining related company in our model portfolio. But I'm not really sure why it's not in a reliable category. Maybe we can come back to and we can give you more color on that.
Yep. I'll move on to this next question by Sagar. Hello, sir. What's your views on the EMS sector? As many companies have fallen in, it is the right time to buy or average down. Is PE or PEG better way to look while investing?
So I think we know that one company came under a lot of scrutiny. I don't want to name that company because one broking firm came out with the little concerns on the corporate governance side, and that company took a huge beating. Management denied nothing doing, but that was what happened. Just to make one disclaimer that we do own one company in our PMS from that sector. One of the best way I think is a PEG because when you look at this PE, I think it gives you will always feel why should I invest in that company, because they are always commanding a little rich premium, and the reason why they are commanding a rich premium purely because the growth has been fantastic in those companies, and that's how you should look at it. So I would say the PEG is a much better way to look at those companies, and be careful with the quality of company that you see. There's a one fear that market is having right now is the quality of earning that mid and small caps company have been reporting. We don't know. A couple of companies came under scanner from the investors. We need to wait and watch. Are there more? Because what happened when the market is doing very well, there is a pressure on the management to show good performance. If you don't show the good performance, your company can come under what we call a lot of selling pressure. And then sometimes one of the what we call KRA for the CEO or the MD of the company is that price appreciation, how much wealth you have been able to create for the investors. And sometimes even some of the best management succumb to that pressure and keep doing that. So my sense is that be careful within the PMS, go to some of the topmost player within that, and use PEG as a parameter to evaluate the company.
Okay, this next question, Amrita wants an opinion from both of you all. What is your equity outlook for 2026?
Mohit can
On
disclose his equity outlook. I will disclose in first week of January.
outlooks are the same. But we will wait for the 1st of Jan, because we obviously will come with a very big webinar format in terms of giving you the outlook. But all that I can tell you is that we are one of the very few houses who's been talking about a possibility of a bull run. And nobody's even close to that today in terms of trying to stick their neck out. But as always, Markets Mojo, whether our neck gets cut or it gets hanged, we do take a view, because it's about having a view rather than having no view, right? So our view is that next year will be double-digit year. Our view is that there is an advent and the making of a bull run that we are seeing fundamentally. If you look at export-import deficits, if you look at tariff being priced into the market, if you look at the valuation gaps that we are seeing, if you look at the corporate earning September quarter results that we saw, if you look at the de-risking of the other asset classes that may happen, if you look at the risk-on strategy that might come into the market. So there are various factors that in the last couple of weeks we have discussed, which to us gives us visibility of a very good run coming in 2026. Having said that, please wait till the first week of Jan. We will come out with a very large format and very detailed presentation to you to tell you exactly. In fact, we have this whole view of even giving a number on the index that we might see. But more than the number on the index, if you were to look at today the advanced declines, and if you look at only so, for example, in small caps, 80% of companies or 80% of the companies have actually lost money rather than gained money. Mid caps, that number is maybe 63%, and in large cap, 56% have advanced and maybe 44% have declined. So the pertinent point out here is not just where the markets will go, but pertinent point is what should be the investment strategy in that market. Should you be small cap heavy now? Should you be mid cap heavy now? Should you be large cap heavy now? I think that the internal working of the market is where we want more detail on, which we've so far not done in terms of what kind of allocation will work the best in 2026. So I think we like to pick that detail now and present to you in the first week of Jan. So give us some time, and we will, obviously, we know this topic is important. We know the time is right, and we know what kind of answers we need to give. Not a very broad answer, but very pinpointed answer in terms of where we feel the allocations going.
Okay, this next question by DV Raj. Which one to give importance to? Mojo stock, stock of the month, reliable or momentum? What do you think should be the order of importance?
Well, if you ask me, various of these strategies can work very differently in different markets. So, two evergreen strategies will be, if you ask me, Mojo stocks and reliable are the most evergreen strategies. Things that work very well in bottoms up market, where the market is on a revival mode, is turnaround and momentum. They work very well when there's momentum in the market. So no one strategy or two strategies you will see across working very well, unless the main parameter of those strategies is great quality of stocks, which is there in Mojo stocks and reliable, and hence those are the evergreen strategies. I am still telling you one thing: a lot of you are not focusing on reliable performers. You should start looking at that. Right. I can see the traffic on the site. I know Mojo Stocks is where most of you go and visit and see the stocks. You guys are not taking reliable stocks seriously. and that is something that will run past you. So that is something that you should see. As soon as a little momentum comes, you should start looking at momentum now and turnaround strategies, because those strategies work very well when it figures out the momentum in the market. I will be doing in the first week a very detailed Mojo One performance review. What we have decided, we started last month itself, is that we should come and tell you all the strategies, how well they worked or not worked, the whole Mojo One strategies. And we typically rank our products out there. So I would be doing that in the first week of Jan. That whole strategy, we will discuss the whole year, and we will also discuss the month of December, how they went. But typically, that's my view.
Okay, Mr. Modan Sunil, that's it with the Q&A session for today.
All right. Thank you so much. Have a great weekend ahead, and we'll see you next week as always.
Thank you a lot, everyone. Yeah, we